Hello, everyone, and welcome. In economics, every data point tells a part of a larger story. And today, we're diving into a really fascinating plot twist in India's economic narrative. After a pretty long dry spell, foreign direct investment, or FDI, seems to be back with a bang. But what's really going on behind these numbers? And more importantly, what does it mean for your GS Paper 3 preparation? Let's get right into it. Okay, take a close look at this chart from the RBI. For 6 consecutive months, the net FDI was negative. That means more money was leaving India than coming in. But then, look at February. The jinx is broken. And it's not just a small recovery, we've hit a 45-month high. This isn't just another statistic, aspirants. This is a major economic development, and you can be sure it's hot-ticket material for your upcoming mains exam. So the big question is, how did we get to this pretty impressive $4.6 billion figure? Well, it's really a story of two moving parts. The money coming in, that's inflows, and the money going out, outflows. Let's begin with the positive side of the story, the surge in investment flowing into India. $9 billion. That's the gross FDI that came into the country in February alone. Just to give you some context, that is the highest figure we've seen in 7 months. It's a clear signal that, global investors are looking at India with renewed interest and seeing it as a key place to park their capital. And it gets even better. We're looking at a year-on-year growth of over 60%. That's huge. This isn't just a minor improvement. It's a massive jump in investor confidence compared to the same time last year. It really shows some serious momentum. So where is all this money headed? Well, it's not concentrated in just one or two areas. The investment is flowing into key sectors like manufacturing, IT and computer services, finance, business services, and communications. This diversity is a really healthy sign. It suggests a broad-based recovery, not just a bubble in a single sector. And who are the big players investing in India's story? Well, they're our trusted long-term partners. Nearly 3/4 of all this investment is coming from just these 5 countries. For your exams, understanding these capital flows and relationships is absolutely vital, not just for economics, but for your IR papers as well. Exactly. But as impressive as those inflow numbers are, they're only half the equation. To build a truly comprehensive, high-scoring answer for your mains, you have to dig deeper and look at what's happening on the other side of the ledger, the outflows. After all, the net in net FDI means we have to consider what's leaving as well. So when we say outflows, we're talking about 2 main things. First is repatriation and disinvestment. That's basically foreign companies taking their profits back home. The second is outward FDI, which is when Indian companies go out and invest in projects abroad. And in February, we saw a really significant change in both of these. Now, this is a critical point. The amount of money foreign companies sent back home dropped to its lowest level in over 2 years. Think about what that means. They aren't just bringing new money in, they're choosing to keep more of their existing profits in India. It's a massive vote of confidence in the stability and future of our economy. And that's not all. At the same time, Indian companies also invested less money abroad. So you have this perfect combination of factors, more money coming in and significantly less money from both foreign and Indian firms going out. This is exactly the kind of nuanced detail that will elevate your analysis in an exam. Right, so the headline figure looks really strong. But as a good civil service aspirant, you know that your job is to look beyond the headlines. Is this FDI creating new factories, new jobs, and new assets on the ground? Or is it simply money moving around in existing assets? This brings us to the crucial concept of greenfield investments. Now, the official line from the Reserve Bank of India is very optimistic. They state that India continues to be an attractive destination for greenfield FDI projects. And this is the official view you need to be aware of. But a critical thinker, which is what the UPSC wants you to be, has to probe further. Is this headline number translating into real, tangible investment on the ground? Are new factories being built? Are new jobs being created? Or is there a disconnect? And here's the catch. This is the data that complicates the otherwise rosy picture. The actual number of new greenfield project announcements has fallen by 11% compared to last year. This is a major red flag. It suggests that while the financial flows look good, it might not be translating into the long-term asset-creating investment that truly powers growth and employment. So what we have here is a classic scenario for a mains question. You have a positive trend, the net FDI bounce back, and a negative one, the decline in greenfield projects. This is the kind of complexity the UPSC absolutely loves to test. So how do we structure all of this into a brilliant, high-scoring answer? Let's connect the dots. First and foremost, you must have absolute clarity on these two terms. Greenfield FDI is when a company comes in and builds a brand new facility from scratch. Think a new factory, new office, creating new capacity. Brownfield FDI, on the other hand, is when a company buys or leases an existing facility. The distinction is crucial because greenfield is generally associated with greater new job creation. So, using this framework, think about how you would approach these potential questions. Can you critically analyze the trends, weighing the pros of high net FDI against the cons of low greenfield investment? Can you discuss the quality of investment? And can you suggest concrete policy measures? This is the level of analysis required. All right, so to sum up, here are your key takeaways. 1. The positive net FDI is great news for macroeconomic stability. 2. This recovery is a double whammy of higher inflows and lower outflows. 3. The fall in greenfield projects is a serious point of concern for long-term growth. And finally, and most importantly, a balanced, nuanced view that acknowledges both sides is the key to a top-tier answer. So we'll leave you with this final thought to ponder. Is this FDI recovery the beginning of a long-term structural improvement for the Indian economy? Or is it more of a temporary boost, driven largely by money simply not leaving the country? There's no easy answer, and your ability to analyze the data as it evolves will be what sets you apart. Keep thinking critically, keep analyzing, and keep up the hard work. We'll see you in the next one.